Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video there will be this section here, which is click on this link for descriptions, links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on the specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in today's video we're going to go over the basics of how the Day Trading GPS SPX Daily Key Levels indicator works, specifically the V2.0 version of this indicator, which was released several weeks ago. This indicator works on the TradingView platform, and it works on two different SPX symbols on the TradingView platform. So the first symbol and the main symbol that it works on is the SPX symbol under the CBOE exchange. So for example, you would go into simple search, you would type in SPX, and then you would look for the SPX symbol under the CBOE exchange. This is the symbol that you would use the indicator on for trading SPX index options. The indicator also works on a second symbol, which is the SPX 500 8 cap. That is this symbol here. So in TradingView, you would go under simple search, you would type in SPX 500, and you would look for the SPX 500 symbol under the 8 cap exchange. This is what's known as an index CFD. It is a Forex CFD. Now, the reason that you would use the indicator on this particular symbol is for a couple of different reasons. One, if you're trading through a Forex broker, and thus you're not trading SPX index options, and you're instead trading SPX through an index CFD, then you would use the indicator on this particular symbol as opposed to the CBOE SPX symbol, which is for trading SPX index options. Or if you're taking a trading challenge with one of the Forex-based trading challenge companies, such as FTMO, Apex, the 5%ers, or one of the 60 to 80 different Forex-based trading challenge companies, in which you pay a fee to take a trading challenge, and if you make a certain amount of profit within a certain amount of time, or in some cases there is no time limit and you are just making a certain amount of profit in your trading challenge account without violating either your daily loss limit set by the company or your total loss limit set by the company, then if you pass the challenge by making that profit without violating the loss limits, then you can qualify with that company to get a funded live trading account in which you trade their risk capital, and then you do a profit split with them for anywhere, depending on the company, between 80% and 95%, depending again on the company that you get to keep, and then the rest is the percentage that they get to keep. Now, there is a third reason why you might want to use it on this symbol on a second chart if you were instead trading SPX index options and normally would trade with this indicator on the CBOE SPX symbol, and that is you can get the levels for CBOE SPX at 9 a.m. instead of 9:30 at the 9:30 a.m. New York Open of the SPX index. The CBOE SPX index does not trade in the pre-market and does not trade in the overnight, and it opens at 9:30 a.m. Eastern New York time. Whereas the SPX 500 index CFD on the ACAP exchange does trade in the overnight and in the pre-market. And thus at 9 a.m. when the indicator knows what the key levels are going to be for today's session, you will see two different tables on your SPX 500 ACAP chart as you see here. So you'll have your key levels for SPX 500 ACAP index CFD here and also here in this table. And then you have this additional table here which will give you the CBOE SPX Daily Key Levels again at 9 a.m. This allows you to get a 30-minute jump on the CBOE SPX session if you're trading CBOE SPX index options and knowing what the key levels are going to be 30 minutes before the 9 a.m. Eastern New York Open. So again, if you're trading SPX index options, you would have your chart on the SPX CBOE index. So at the 9:30 a.m. New York Open for this exchange, then you would see the same table here that you saw on the other chart, and then you would see the same levels here that you got at 9 a.m. on the first tick of the 9:30 a.m. Eastern New York Open for the official CBOE SPX index. The CBOE SPX symbol is the main SPX index that everyone follows. Now what you're looking at here is what the default startup look is going to be for the display for this indicator. As you can see here, we have a table that has the bull bear key price level for today's session, which for today, Monday, November 24, 2025, is 66.3986. And then we have the other main key levels, the R1 through R6 levels and the S1 through S6 levels. Now as you can see here, we've drilled down to the R3 through S3 levels and also included the YDL level here, which I will get to in a second what these levels are. So even though you have the 6 levels, you can see that if you have all 6 levels on your chart, it squunches up this area here, which is very important for the beginning of the session. So when utilizing this indicator, you do not want to start off the session having all 6 levels above and all 6 levels below displayed. You instead take your mouse over here and you would drag your mouse and expand the chart so it is either R3 through S3 or some combination of R3 through S2 or R2 through S2, but somewhere in the R3 through S3 range. If you want, you can even further drill down to the R2 through S2. And as you can see here, this gives you a more granular view at the beginning of the session for these levels in here, which are going to be the most important levels at the beginning of the session. Then as the session progresses, you can expand your chart out to include other levels in the direction of where price action is taking us for this session. Okay, you'll also see these levels here, the YDL, YDC, PML, PMH, and YDH. These levels are as follows. The PML is the pre-market low. The PMH is the pre-market high. The YDH is the previous day's RTH session high, which in the case of, or you can look at it as yesterday's daily high, YDH. Since today is a Monday, then this would represent the last trading day previous to Monday, which in this case would be last Friday's RTH session. The YDC level is yesterday's daily close, specifically the previous trading session's RTH session's daily close. The YDL is the previous daily RTH session low. These levels are also very important levels as far as the context of the session as follows. So for example, for there to be any significant move to the upside, price is not only going to have to start closing above the bull bear key price level, but also start closing above and stay above the pre-market high. Conversely, for a significant move to the downside, price is not only going to have to start closing and holding below the bull bear key price level, but also closing below and holding below the pre-market low. The YDH, YDC, and YDL levels are also very important levels, as they can also represent significant support or resistance depending on the context of the session. So for example, here we have YDH very close to the pre-market high, and also YDH is under the R1 level. So for a significant move to the upside, price is also going to have to start closing and holding above YDH in this particular session. Or conversely on the downside, since we have PML close to YDC, for a significant move to the downside, and these levels are still close to the S1 level below the bull bear key price level, price is going to also have to break through not only the pre-market low, but also the YDC level for there to be a significant move to the downside. The YDL level represents the daily low from yesterday's or the previous RTH session low. Oftentimes this can be where price, if we do have a move to the downside in the session, price would seek the YDL level, and also that would be considered a potential reversal point for price action. Or if it slices through YDL and starts holding and closing through YDL, then that can represent significant potential for a expanded move to the downside. Now also you'll see here the midpoint levels above and below the bull bear key price level, and also these QL levels above and below the bull bear key price level. These are the only midpoint levels and QL levels that are displayed by default on the startup of the indicator. You can also enable other QL levels and other midpoint levels by simply going into the user control panel and enabling those levels down in their respective sessions. So for example here I can turn on mid R1, R2 and mid R2, R3. And as you can see here, now we have these midpoint levels here. Conversely, you can also do that to the downside. However, in today's session, since so far price action is taking us in the up direction, then there was no need to turn on these particular levels. However, should price start collapsing through the bull bear key price level and also through these levels, then you can turn on the midpoint levels down here when it becomes relevant in the session. Also, you have QL levels above and below each level that can be enabled down here in the QL section. So for example, if we wanted to turn on the QL below R1 and the QL above R1, then we could simply enable those, as you see here. Now what do these levels represent? The midpoint levels and the QL levels. The midpoint levels have several different purposes. One of their purposes is for a standard stop loss above and below each of the main levels. The main levels on the V2.0 indicator are the SPX Bull Bear KPL level, as well as the R1 through R6 levels and S1 through S6 levels. So for example, if you were taking a bullish trade off of the bull bear key price level, your standard stop loss would be the midpoint level below the bull bear KPL, which would be this level, mid BBKPL S1. If we were taking a bullish trade off of R1, then our standard stop loss would be mid BBKPL R1, or the first midpoint level below R1. If we were taking a bullish trade off of R2, then our standard stop loss would be the midpoint level below R2, the mid R1, R2. And we'll show you the other levels on the S levels just for context. So for example, we can go down here and turn on mid S1, S2 and mid S2, S3. So for an example, if price started traveling down below S1, hit S2, and then started curling back up above S2, and you wanted to take a bullish trade off of S2, then your standard stop loss would be the first midpoint below S2, the mid S2, S3 level. Or if you instead were taking a bullish trade off of the S1 level, then the standard stop loss would be the mid S1, S2 level. Conversely, if you were taking a bearish trade off of S1, then the standard stop loss would be the first midpoint above the level that you're trading, in this case the S1 level. And the same with the S2 level. If we were having a significant downside day and we started having closes below S2 and you were taking a bearish trade off of S2 seeking for it to go to at least S3, then your standard stop loss would be the first midpoint above S2, mid S1, S2. Now we'll get to the other purposes of the midpoint levels here in just a second, but now we'll explain the QL levels. The QL levels have one singular purpose, and that is for providing a tight stop loss level above and below each main level. So for example, if you were taking a bullish trade off of the bull bear key price level, your tight stop loss, if you prefer to use a tight stop loss, would be the QL below the bull bear KPL, QL below BBKPL here. If you were taking a bullish trade off of R1, then you wanted to use a tight stop loss on that bullish trade from R1, then your tight stop loss would be the QL below R1. Whereas if you wanted to use the standard stop loss, it would be the midpoint below R1. And the same thing with the bull bear key price level. This would be your tight stop loss in a bullish trade from this level. This would be your standard stop loss. And the same thing works on bearish trades. If you were taking a bearish trade from the bull bear KPL level, then your tight stop loss would be the QL above the BBKPL, the level that you're trading. Whereas the standard stop loss on this bearish trade from this level would be the midpoint level above. And the same thing with other levels. If you were taking a bullish trade off of R1, then it would be the QL below R1. However, if you were taking a bearish trade off of R1, then it would be the QL level above R1 would be your tight stop loss. So the QL levels represent tight stop losses for either bullish or bearish trades from the level that you're trading, and the QLs above would represent tight stop losses on bearish trades from the level that you're trading, whereas the QL levels below the level you're trading represent the tight stop loss for bullish trades from the level you're trading. Okay, so one thing that is important to note is that with this particular indicator, you can take bullish or bearish trades off of any of the main key levels. So again, the main key levels are the bull bear key price level, the R1 through R6 levels, and the S1 through S6 levels. You do not take trades off of the midpoint levels or the QL levels. Also, the V2.0 indicator also has additional levels above R6 and below S6. So for example, you can come in here and you can turn on levels 7, 8, 9, and 10. Now, these levels would be used in extreme volatility situations. So if we get back to, say, a period like we had in the 2007-2008 market meltdown, when we had the real estate crisis and we also had the financial crisis going on, and we had extreme volatility for significant periods of time, those would be periods in which you would want to use additional levels. Or, for example, during the COVID pandemic, where we had weeks of extreme volatility situations to the downside and also to the upside, those would also be situations in which you might want to go ahead and turn on levels 7 and above for those extreme volatility situations. In most cases, in low to medium or normal volatility, most of your price action will be confined with SPX between the R3 and S3 level on most sessions, with there being some sessions throughout the year where, due to significant news events or other earnings events on major stocks that occur either to the upside or downside that can affect the market from mega cap stocks, you may see moves that exceed R3 or S3 into the R4, S4, R5, S5, or R6 or S6 levels. However, those do not happen very often, but sometimes those situations just happen during a session where news can just come out. So that's why the standard default levels are the R1 through R6 or S1 through S6. However, in the user control panel, if you prefer not to have those levels turned on, then you can simply uncheck the levels that you prefer, and then you can save that as the default look on your particular indicator, also for your use of the indicator. Also, as far as having midpoint levels turned on and off and QL levels turned on and off, you can also go into the user control panel, and of course you can enable or disable those particular levels to your liking as well, if you prefer to have different ones enabled or not enabled on the startup display for your particular trading process. Now, these tables that you see here are also useful depending upon how you like to have your chart laid out. These particular tables here can be independently controlled, and they can be as far as size and also their position on the chart. They can also be independently controlled to either turn them on or off. So for example, you could go in here and go down to this table here, and now it will turn this one off. Or for example, you could go here and turn this table off. Or you could simply turn both of them off if that's your preference. Now also, these line labels are also independently controlled by group. What do I mean by group? The main levels, the R1 through R6, the S1 through S6, and the bull bear key price level are a group. The QL levels are a group. The midpoint levels are a group. The PML and PMH levels are a group. The YDL, YDC, and YDH levels are a group. You can go into the user control panel, and you can control these by a group and also control the offset. You can also control the main line label text size, the midpoint line label text size, and the QL label text size. So for example, as you can see here, the QL lines, the line labels are on the small text. However, if I wanted to change it to large, then I can make them large, or normal, or small. And you can do the same with the others. Right now, the main level line labels are large on default. The midpoint are the normal text size, and the QL labels are the small text size. Then if you go down to the pre-market low, pre-market high, you can see here that you can also change those as well. So for example, if I wanted to put these to the large size for the pre-market low and pre-market high, then I can change that. And I can also do the same thing with the YDH, YDC, and YDL levels, change them from normal to large. You also have an offset. This offset moves the line labels to the left or right, depending on whether you have a negative number or a positive number. A zero number would put them in line with current price action, whereas a positive number moves them more to the right of price action, and a negative number moves them to the left of price action. So you can control the line label offset for each group as you would like to have for your chart display that you prefer. Also, you can change the colors of the lines, as you can see here. Now, we're not going to go into every aspect of the inputs in the indicator today. We do have a video that is about an hour long that goes into all the different inputs in greater detail, and you can see a link to that video in the description of this video if you'd like to see a more detailed presentation of all of the different inputs that are in the user control panel. Okay, so now we're going to go back. We're going to turn off these additional levels that are irrelevant in today's session. Okay, so what about trading with the indicator? There are two different types of trade entries with this indicator. We do have a video that goes into detail on the two different types of trades with this indicator. That is found in the document in the Google Drive link that is in the description of this video. When you click on that Google Drive link, it'll take you to a Google document that will have links and descriptions to various videos that go into detail on specific topics. One of those is a video on taking bullish and bearish trades from any of the main levels, as well as it explaining the two different types of trade entries that you can take with this indicator. One being the standard trade entry, and the other one being the more conservative trade entry, which requires additional confirmations. And that video also goes over several examples of both the standard and the more conservative entry on both bullish and bearish entries, and how to recognize both of them. So for more information on that, please refer to that video. As far as trade entries of bullish and bearish, we're going to look at today's session as an example. So the most important key level that you have on any given session out of all the main key levels is going to be this level here, the bull bear KPL, which stands for key price level. This is the main, most important bull bear price pivot for today's session. So the indicator, after analyzing recent price action in the SPX, as well as current market dynamics, volatility, and also overnight and pre-market price action in the ES E-mini futures, the indicator analyzes all of that with its different algorithms and comes up with the bull bear key price level, or the bull bear pivot for the current session, and then also the R1 through R6 and S1 through S6 levels for this particular session. Each day the indicator will analyze the market and update these levels for each session. As we indicated earlier, if you have it on the SPX 500 8-cap, you can get those levels 30 minutes early at 9 a.m. Eastern, 30 minutes before the 9:30 a.m. New York Open of the CBOE SPX Index. While on the CBOE SPX Index, then you will get the levels directly on the CBOE SPX Index chart at the first tick of the 9:30 a.m. Eastern New York Open. So every day in the morning, you will get new, fresh key levels given by the indicator that are the most relevant levels for the current session. Okay, so as far as trading with this indicator, as you can see here, we have the 9:30 a.m. candle marked off for today's session, Monday, November 24th, 2025. As you can see, this candle opened below the bull bear key price level, but crossed above and closed above the bull bear key price level. So for taking an opening candle trade, this is your bullish entry signal for taking a trade off of the bull bear key price level. If instead price had closed below the bull bear key price level on this opening candle, then instead that would be a bearish trade signal for taking a bearish trade off of the bull bear key price level. The 9:30 a.m. opening candle trade is part of the daily key levels SPX index option strategy with this indicator. However, it is a optional trade to take. It is not a required trade to take. This trade is taking a trade on the initial session bias for this session. So price closing above the bull bear key price level represents bullish bias for the session in a bullish entry signal. Whereas if the opening candle closes below the bull bear key price level, that represents bearish session bias and a bearish entry signal. One thing that is important to note with the 9:30 a.m. opening candle close is whether the close of the candle is within range or out of range. In other words, there are 9:30 a.m. candle closes to avoid taking trades on. We do have a video referencing that Google Drive link again. If you will click on that, there is a specific video which is about 9:30 a.m. candle trades to avoid, how to recognize them, and how to discern what is within range and what is out of range. There is also an accompanying PDF document to that video, which we provide a Google Drive link on as well, which is a multi-page document which goes into explaining in further detail what is considered within range or out of range for a trade on a given level, specifically the 9:30 a.m. opening candle trade off of the bull bear key price level. That within range and out of range would also apply to other key levels as well. So please refer to that video and that document for that aspect of trading with this indicator. For this particular session, this candle here, closing where it closes, is within range for it is within the acceptable range for a trade off of the bull bear key price level, specifically a bullish trade. If, for example, it had closed out of range, then you would instead avoid the 9:30 a.m. opening candle trade, even though it does close above or below the bull bear key price level, and then you would simply wait for a better opportunity off of either the bull bear KPL later on in the session, or taking a bullish or bearish trade off of one of the other main key levels as the session progresses. Now, as you can see here in this session, as we stated earlier, this one did close above the bull bear key price level, so that is the bullish entry signal for taking a trade on the 9:30 a.m. candle. There are always going to be 3 different option strikes that you can use with this indicator on any particular bullish or bearish trade. So now I'll go through the steps of showing you what those would be in the case of this particular session and this particular bullish entry signal off the 9:30 a.m. candle. So today's bull bear key price level is 66.3986. The standard option play for a bullish entry signal off of the bull bear KPL level is an at the money call strike closest to the price of the current session's bull bear KPL. So in this case, a 66.40 strike is the closest to 66.3986. So that would be your standard play is a 66.40 call option. Now with this indicator is for day trading only. So that means that you are opening and closing your positions all in the same session. Since the indicator gives new, fresh, updated key levels each morning, this indicator is for use for day trading only and is not for use for swing trading. So what we mean by that is that you will be opening and closing all of your positions while using this indicator all within the same session. And then you would end the session flat for the day, and then you would look forward to the next day's session when you have new key levels, and then you would make new day trades off of those levels if you happen to be trading that session as well. Now what about out of the money call options on this particular trade? As I stated before, there are 3 different strikes you can consider for any bullish or bearish trade off of any of the main key levels. So for example, with this trade here, there's 3 option strikes that you can consider. One is the standard play, which is the at the money strike, which in this case would be a call strike, the 66.40. How you figure out the other 2 option strikes you can use is as follows. You look at the level you're taking the trade from, in this case the bull bear KPL, the direction the trade is in this case a bullish trade, and you look to the first midpoint above. In this case, that is mid BBKPLR1 for today, 66.5348. And the closest strike to that is going to be the 66.55 call option. So that would be your second strike you can consider, which is a slightly out of the money strike. The furthest out of the money strike, and the third option you can consider on this trade, is you look to one level above. We're looking above since this is a bullish trade. The R1 level is one full level above, 66.6709. So that strike would be the 66.65 call. that would be the furthest strike that you would consider while taking a bullish trade off of the bull bear KPL level. If instead this was a bearish trade and the opening candle had instead closed below and we were instead looking at a bearish trade off of the bull bear KPL, then we would do the reverse. Then we would be looking below, and then our at the money standard play would be a 66.40 put. And then our two other option strikes we could consider on a bearish play from the bull bear KPL would first be this midpoint below, mid BBKPLS1 66.2625, so that would be the 66.25 put. Then our furthest out of the money one that we could consider would be the strike closest to the S1 level of 66.1263. Now this is slightly over the midpoint between two strikes. So SPX trades in 5-point increments. So we have 66.15 and 66.10, with 66.1250 being in the middle. Since this is slightly over the middle, then you would defer to the 66.15 strike, as that is the closest strike to 66.1263. So the 66.15 strike would be your, as far as a put option, would be your furthest strike, or the third option you could consider for a bearish trade off of the bull bear KPL. And it works the same way with taking bullish or bearish trades off of any of the other main key levels. So for example, if you were taking a bullish trade off of the R1 level, your at the money standard play on a bullish trade from the R1 level would be the closest strike to the R1, 66.6709, and that would be the 66.65 call option. Whereas your first out of the money strike, or your second option, would be the strike closest to the midpoint above on this bullish trade from the R1, which would be mid R1 R2, 66.8071. So 66.80 call would be your second option out of the three. And then the R2 level is one full level above, 66.9433 would be the 66.95 call option strike, and that would be your third option that you could use on a bullish trade from the R1 level. And then the same thing works in reverse. If we were instead looking at price starting to close below the R1 level and we were wanting to take a bearish trade off the R1 level, then our at the money standard play would be a 66.65 put. Then our second out of the money option that we could consider would be the closest strike to the midpoint level below R1 on this bearish trade from R1, mid BBKPL R1, 66.5348. So that would be the 66.55 put. And then our furthest out of the money would be the strike closest to the bull bear KPL, since that is one full level away in the direction we're trading off a bearish trade off of R1. So that would be the 66.40 put. Okay, so there are two different types of trades you can take with this indicator. The two different types of trades you can take with this indicator are scalp only trades and regular trades. On a scalp only trade, you're looking for a one level move in your favor, and then you are closing out 100% of all of your option contracts when that one level move in your favor is hit. How do you figure what a one level move in your favor is? With this indicator, you would take the level that you're taking the trade from. In this case, in this example here for today's session, the bull bear KPL level is the opening bullish trade. What is one full level above the bull bear KPL? That is the R1 level. So as you can see here, when price hits the R1 level, then that is your trigger for exiting the trade if you're doing a scalp only trade. If, for example, you were taking a bullish trade from R1, then when price hits R2, then that would be your trigger for getting out of that scalp trade. If you were instead taking a bearish trade, if we had a down day, and let's say you were taking a bearish trade off of S1 on a close below, cross and close below S1, then your scalp on that bearish trade from S1, your target would be S2. If you were taking a scalp from S2 on a bearish trade, then your one level move would be S3, and that would be your trigger for getting out on a scalp there. The other type of trade that you can do with this indicator is what we term a regular trade. On a regular trade, you're looking for a 1.5 level move in your favor as the minimum required move for the trigger to trigger all these different options that you have once the 1.50 level move in your favor has been met. Those are as follows. Either 100% closeout of all of your options, so whether you're trading 1 or 2 or 3 options or 5 options, 10, 20, etc. Just like with scalps, you can do a 100% closeout. Or you can adjust your stop loss on all your contracts to break even. What that means is that you move it to the price that you paid for the option when you entered the trade, or break even plus a 10 to 15% initial profit buffer. So that would be the price of the option that you paid plus adding 10% more. So for example, if you bought the option for 20, 10% of 20 is $2, so break even plus 10% would be $22, versus if you just wanted to move it to break even, then you would move your stop to 20. Or if you did 15%, 15% of 20 is 3, and you could move your stop loss to 23. So with this indicator, when you are doing your trade entry, your initial stop loss is based on levels. However, when you adjust your stop loss, once it's met this 1.5 level move threshold, then you are changing from a level-based stop loss to a price-based stop loss. Now, for those that are not familiar with level-based stop losses, there are a couple of ways that you can manage your level-based stop losses. One is just either setting an alert for when price hits that particular price level, and then you would manually stop yourself out. Or you can simply watch price action for when price touches that level and manually stop yourself out. Or if your broker is a broker that offers the feature of being able to set stop losses for options based on the price of the underlying, then you can simply use that feature to instead set it to automatically stop yourself out if price hits that certain price level. There are a couple of brokers that offer that feature. One is Thinkorswim, which is now owned by Charles Schwab. It used to be owned by TD Ameritrade. And then the other broker is Interactive Brokers. If you look in the Google Drive link again, and refer to the Google Drive link that's in the description of this video, that takes you to a Google document which has descriptions and links to videos on specific topics about this indicator. One of those videos is going to be on using level-based stop loss feature through Thinkorswim. So if you look at that video, it will show you how you can use that feature in Thinkorswim to instead be able to automatically set your stop loss through the price of the underlying, in this case SPX. So if SPX happens to trade at that price level, it will automatically stop you out. And that feature works the same way in interactive brokers. Now there may be other brokers that do offer that feature. If you have an account with one of those two brokers, then I would invite you to ask your broker if they have a feature that allows you to set the stop loss on your options based on the price of the underlying. If they don't offer that feature, then you may want to check with other brokers to see if they offer that feature, or you may want to consider moving your account to either Thinkorswim or Interactive Brokers. That feature can also be used for take profits as well, so you can do a take profit based on the price of the underlying, as you can see here in a minute when we get to explaining the target exits. So that feature can also be used for that as well. If your broker does not have that feature, then again on target exits, then you would need to just watch price action to see when price happens to touch the target exit level, and then you would simply close out your trade or do a stop loss adjustment based on the price touching that particular take profit level. Okay, so another option here is if you're trading multiple contracts, you can close out 70 to 90% of them and adjust the stop loss on remaining runners to break even or break even plus a 10 to 15% initial profit buffer. So for example, if you were trading 3 contracts, when it hits this minimum 1.5 level move threshold, then if you're trading multiple contracts and you prefer to scale out, then you can close out, for example, if you had 3 and you closed out 2, that's approximately 70%. It's roughly 67%. If you had 4 contracts and you closed out 3, then that would be 75%. If you had 5 contracts and you closed out 4, that's 80%. If you had 10 contracts and closed out 7, that's 70. 10 contracts closed out 8, that's 80. 10 contracts closed out 9, that's 90% as an example. Then at each succeeding level move in your favor, after the initial minimum required 1.5 level move, you have the same options decisions to make at each succeeding level move in your favor. So now we'll take a look at an example. So let's say you were not doing a scalp, so you did not close out here. You were doing a regular trade. Well, in this particular example, if you were doing a regular trade and you were using the standard stop loss, which again is the midpoint, first midpoint below the level that you're taking the trade from, if it's a bullish trade, your standard stop loss would have been this level and you were not stopped out. The standard stop loss, by the way, is the recommended stop loss to use with this indicator. We offer both stop losses because some people prefer to use tight stop losses because of the risk profile, and that's fine. It's just that you just need to be aware that if you use tight stop losses, they are more prone to getting stopped out, as was the case here. But if you were using the standard stop loss, you were not stopped out. And then eventually price here on this candle finally reached the mid R1, R2 level, which is a 1.5 level move from the level we started the trade from, that we initiated the trade from, and that the trade is derived from the bull bear key price level. This is a 1 level move, that's the scalp. This is a 1.5 level move. So when price hits this, then you have all of these different options here. Either closing all of your contracts out, scaling out if you are trading multiple contracts of say 3 or more, or adjusting your stop loss to break even, or break even plus 10 to 15% profit buffer on all of them, and then waiting for a succeeding level move in your favor to again go through that decision making again, either to close out or continue to trade on to see if it gets to the next level. So in this case, this is the 1.5 level move from this level where the trade started. And then a 2 level move would be the R2. then a 2.5 level move is this midpoint here, and a 3 level move would be R3 from this level. So that's what we mean by each succeeding level move in your favor after the minimum 1.5 level move has been met. Now also, if any of the PMH, PML, YDH, YDL, or YDC levels happen to also be in the direction of the trade continuing in your favor after the 1.5 level move has been met, those are also additional waypoints or decision-making points, the same as you would have with either the main levels or the midpoint levels also occurring after the 1.5 level move threshold. In this case, on a bullish trade, in this particular session, none of those levels happen to be in the direction of this trade from this level after the 1.5 level move has been met. However, as an example, let's just say that price travels all the way up to R3 and then started closing below R3, and we had some bad news that came out, and now price was starting to travel below, and you took a bearish trade off of R3. Well, then the 1.5 level move from R3 threshold would be this mid R1, R2, whereas the scalp only would be R2 on this bearish trade from R3. Then, after this 1.5 level move here, as you can see, these levels are in the direction of that particular trade. So after it met the 1.5 level move here, the R1 level would now be the 2 level move in your favor. And then you would also have a decision to make at the YDH level should price travel down to that, because it is in the way and it's also after the 1.5 level move in your favor. And thus, each one of these, if price continued to move down, you would have the main levels, the midpoint levels, as well as these levels to make decisions on at each succeeding level move in your favor. The QL levels are not factored into this. As we said earlier, the QL levels have a singular purpose, which is simply tight stop losses for either bullish or bearish trades above and below each level. Then also, if you already adjusted your stop loss at the 1.5 level move threshold, then optionally you can add additional profit buffers at each level move in your favor on any remaining contracts that you have that you do not close out at each succeeding level move in your favor. So when it, for example, it moves from the 1.5 level move here up to the 2 level move here, then you can either close out the remaining contracts, or you could add an additional profit buffer if you were so inclined to further tighten up your stop loss by adding on an additional amount to your stop loss, price-based stop loss at that time. And then as it continues to move up, you can either close out again any remaining contracts, or you can simply add more of a profit buffer onto your stop loss, and in that realm, what you're basically saying is that you want price to eventually take you out, that you just want to see how many levels it may go. Now, with this particular indicator, another important point is that there are two different types of options that you can use with this indicator. One is 0 DTE options, and the other is 1 DTE options. We do also have a video that is in that Google Drive link, which I explained earlier, that's in the description of this video. You click on that Google Drive link, it'll take you to a Google document that will have various descriptions and links to other details on videos on specific topics of this indicator, one of which is using 0 DTE options versus 1 DTE options. And there's also a couple of trading sessions which we have also there, in which we went through and on those particular videos looked at the differences in the cost of the 1 DTE options versus the 0 DTE options, and then how the profit and loss panned out on each of those as the session progressed, so you can see the differences. So I would invite you to take a look at those, and just keep in mind that with this particular indicator, you are using it for day trading only, so you don't want to use anything above a 1 DTE option, because you will be opening and closing all the trades in the same session. And the reason you don't want to use more than a 1 DTE option is because then you're paying a lot for time value, which is going to be unnecessary, since you are simply opening and closing the positions all in the same session. You're not holding these positions over from one session to another. So there's no reason to pay for additional time value. However, there are some advantages to using 1 DTE options, which we go over in that particular video. So there's pros and cons of both the 0 DTE and 1 DTE, and it's just important for you to know the differences so you can make up your mind as to which is better, which that you feel is better for you in your trading process in using this indicator. Okay, so now we're just going to close out this video by just briefly running through the trades today. So this is the same chart, it's just that now we have through the end of the day, and as you can see here, we have our cross above, close above the bull bear key price level. We have our tight stop loss below the bull bear key price level on this bullish trade taken on the 9:30 a.m. opening candle that closed above. And here is our standard stop loss on the bullish entry on the trade from the BBKPL level, the first midpoint below the BBKPL, mid BBKPL S1 66.26.25. So as you can see in this particular trade, it did hit the scalp only one level move, just simply a couple of candles later after the entry. And here were the entry prices on the different call options. So our standard play was our at the money call option closest to the BBKPL, the level we're taking the trade from, which was the 66.40 0 DTE call option, and the price on the 9:30 a.m. candle close was $30.30. So we have these down here for the different strikes, the at the money and the two out of the monies here. $30.30, 9:30 a.m. candle, 2-minute chart. And then we have the 66.55, which was the first out of the money strike. That was $21 on this 9:30 a.m. candle close. And the furthest out of the money was the strike closest to the R1 level, and that was $16 on the candle close at 9:30. So this is a 2-minute chart. This is the recommended chart time frame for the daily key level strategy, utilizing this daily key levels V2.0 indicator. However, the chart time frames that you can use with this particular strategy are 1 minute up to 5 minutes. However, the 2-minute chart we have found to be the most consistent performer with this strategy, performing better than the other time frames between 1 and 5 minute. So that is the time frame that you'll see on all of our SPX videos. So that is the recommended one. However, if you prefer a 1 minute or a 5 minute time frame over the 2 minute, that is fine as well. You just need to keep in mind that the recommended chart time frame is the 2-minute chart time frame. Okay, so here we have the 9:30 a.m. Candle. The close of the candle hits the R1 level, which is the 1 level move required for the scalp. for 100% closeout of all contracts if you're just doing a scalp only trade. So here we have the bid prices for the close of the candle here. $39.20 for the at the money 66.40, $28.60 for the 66.55, and $22.40 for the furthest out of the money. So the profit per option on the at the money 66.40, $890 profit per option. The 66.55, $760 profit per option, and the 66.65, $640 profit per option. Next we have the data boxes for the 10:40 a.m. candle here, and that is where it hits the minimum 1.5 level move threshold for a regular trade. And if you remember from earlier in the video, this is where you have all those different options for either closing out your contracts, adjusting your stop loss to break even or break even plus a 10 to 15% profit buffer, or if trading multiple contracts, closing out 70 to 90% of them, and then doing a stop loss adjustment for any remaining runners that you would have. The 66.40 call option on this candle close here, where it hits the mid R1, R2 level for the 1.5 level move, $45.50, that's $1,520 profit per option. 66.55, $33.20, that's $1,220 profit per option. 66.65, $25.70, that's $970 profit per option. Okay, so here at the 11:08 a.m. candle, it hits R2 in a regular trade. This is the minimum ideal 2-level move for a regular trade. What we mean by ideal move is that in about 80% of the sessions that you'll see during the 250 to 255 sessions per year on SPX, a 2-level move in your favor is going to be the extent of most moves. On some days you may get the 2.5 level move, but that would comprise about 80% of the sessions in a normal SPX trading year. Of course, there are years where we have increased volatility throughout the entire year, and in higher volatility situations, then you would see more of the 3 to 4 level moves and above in a higher volatility situation. Okay, so on the candle close here, on this candle close of the 11:08, we have 58.20 for the 66.40 at the money. That's $2,790 profit per option. The 66.55 was 44.20, $2,320 profit per option. 66.65 furthest out of the money. Call option $35.40, that's $1,940 per option. Okay, as you can see, we did not get a move up to the next level, the mid R2, R3. We basically went sideways for most of the rest of the day. Okay, so this is going to wrap up this particular video. Also keep in mind that if you do not have this indicator already and you wish to purchase the indicator, we sell all of our indicators on a one payment for lifetime access basis. So what that means is you make one payment and then you have lifetime access to the indicator, in which the lifetime access also includes any updates or any future versions of the indicator that we release in the future that would have enhancements or substantial new features. And in return for watching this video today, you can email us at daytradinggps@gmail.com, and you can request a discount promo code, and we will send you a promo code for a substantial discount on the purchase of this indicator. So again, thank you for watching this video, and we wish you much prosperity in your future trading endeavors.